Adjusting entries, in simple terms. So what are they? And what are they for? Adjusting entries are used to record revenues earned but not yet recorded, and record expenses incurred but not yet recorded. Why do we use them? We use them essentially to keep records up to date and accurate, as well as to make sure that expenses and revenues that span more than one accounting period are recorded. A few rules, however. First of all, no cash. Cash is only recorded when it's flowing in or out, therefore can't be used in an adjusting entry. And secondly, each adjusting entry needs both an income statement account and a balance sheet account. It's pretty simple, yeah? However, there are 4 types of adjusting entries. Firstly, we have deferred revenue, which is when cash is received before the revenue is earned. Then we've got accrued revenue, which is when cash is received after the revenue is earned. Then we've got expense accounts, like deferred expense, when cash is paid before the expense is incurred, and accrued expense, when cash is paid after the expense is incurred. So essentially, accrued means paid after, and deferred means paid before. So we'll start with deferred revenue. Deferred revenue is when cash is received before the service is provided, and it's recorded as a liability underneath unearned revenue. So here we've been debited cash, and we credit unearned revenue. And when the service is complete, it's adjusted to make it an asset. So here we've debited unearned revenue and we've credited service revenue. Then we have accrued revenue. This is for when cash is received after the service is completed and is recorded as an asset under the accounts receivable, either when the service is complete or at the end of an accounting period. So here we've debited accounts receivable and we've credited service revenue. Then once cash is received, it's journalized to amend the receivable. So here we've debited cash and we've credited accounts receivable. So now we move on to deferred expenses. Deferred expenses are primarily used for prepaying for services such as rent and are recorded as an asset. So here we've paid for 6 months rent in advance and we've debited prepaid rent and we've credited cash. So adjusting entry records the amount used up in an accounting period as an expense. So what we do here is we debit the rent expense, which is in this case is half of the 6 months prepaid rent. So then we credit prepaid rent. So finally we have accrued expense, which is used for paying bills after they've been incurred. So an adjusting entry is made at the end of the accounting period to record the incurred expense. So on the 31st of May, we've incurred $500 worth of electricity expense for our uses in May. So we debit electricity expense account and we credit an electricity payable account. Then once we actually pay the bill in June, we debit electricity payable and we credit cash as a simple journal entry.